Hi, Larry Gaines, PowerCycleTrading.com. Well, there are a number of different types of what we call option income strategies, where you collect premium by selling options, against maybe long options. But the basic ones that you probably hear about and maybe know about are the covered calls. Then you've got vertical credit spreads. You've got the iron condor credit spread, butterfly spreads, and then calendar spreads and diagonals. So these are some of the better, more commonly used. So one that's very interesting and it kind of is used a lot is what we call the calendar spread. So let's take a look at that. Now, it's got a couple different what I call trading edges. So the first big one though is time, okay? So time decay, and what's also known as theta. So the reason a calendar spread works is that you're taking advantage of the money from the front month theta decay while you're long the back month. So the back month will stay relatively more unchanged because that theta doesn't decay as much or as fast. So the trade is to sell the front month and buy a back month. It's also called sometimes a horizontal trade or a timing spread. So the basic concept is you're going to profit from the time decay or theta decay from the credit spread of the front month, and then or the short side of it from the front month, and then you're long the back. So it's kind of like a covered call. And here's kind of an example of it on SPX. SPX is a really good index option that you can use for this type of strategy. So this is SPX, the S&P 500 cash. So typically what you look to do is you go out about 30 days out and you go to the at the money. So we'd be looking at the 27, like 75, and you'd be selling that front. So this is like selling a credit spread. Instead of doing it in the same time frame, we're going to split the months and go further back on the long side. So you'd be selling the 27.75, and it's 38.60. You try to get the best, the middle part of that. But the key thing here, you also see that the theta decay here is about 69 or 70 cents. And the theta decay on the back month here is 50. So you've got that 20 cent spread. That's what you're playing. Then this will start decaying faster. So basically what you'd be looking at is, in this situation, selling like the 27.75, and then you'd want to look to buy the 27.75 on 30 days further out. So that's in this setup or example, the 30 April. And this is going to cost right now, about $24. All right, around $2,400. So that would be the spread, and your max risk is your debit paid. So let's take a look at what that looks like on the option analytics. So here's what your risk profile looks like on this particular setup. And what you're looking for is the max profit would be if it goes right out at your short strike at that 27.75. But you've got a big range in here. So you can see that, let's say it doesn't go anywhere for about 2 weeks. And 2 weeks later, this, just based on that, the theta decay, this would be, on one contract, this would be about $140. But that's a typical calendar type trade setup for income. And there's more to it than that, but that's just kind of the general overview.